Okay, you've seen the headlines, right? Housing collapse, stock market wipeout. I mean, we're all kind of bracing for the next big one. But what if we're looking in the completely wrong direction? This whole explainer is about a pretty radical idea, that the next crash, it's not going to look anything like 2008. In fact, it might just be the exact opposite.
So yeah, let's just dive right in. The big question is, are we all preparing for the wrong financial disaster? It's human nature to expect a repeat of the last crisis. We're all wired that way. But what if that's the very thing that leaves us totally exposed to the one that, well, might already be happening right now?
It really all comes down to this classic military mistake, It's called fighting the last war. And in the financial world, that means just about everyone is getting ready for another 2008. They're waiting for asset prices to tank, for banks to fail, the whole nine yards. But according to the thesis we're digging into today, that could be a catastrophically wrong move. Okay, this slide right here, this is the heart of it. Let's break it down. You've got your 2008 style deflationary crash, right? That's when asset prices fall off a cliff, and suddenly cash is king. But then you have this other thing, this reverse crash, and it's the total opposite. Assets don't fall, they skyrocket. And the thing that's actually crashing, it's the cash in your bank account. See the difference? One's a reset button, a second chance to buy in. The other is a lockout. It could price you out of the market for good. All right, let's just take a quick trip in the time machine back to 2008. Do you remember that feeling, the knot in your stomach? Stocks were just in an absolute free fall. For sale signs were popping up like weeds on every street. Banks were teetering on the brink. I mean, it was brutal for sure. But it was also a reset button. If you were one of the lucky few sitting on cash, it was the sale of a lifetime. And that's the exact crash that most people are still waiting for today. But what if that crash never actually comes? This is where we get into the reverse crash thesis. It's a really contrarian idea that says the real collapse, it's not happening in the stock market. It's happening in the value of our money. And look, this isn't some brand new idea that just popped up yesterday. Way back in late 2022, the source for this whole thing, Mark Moss, he really went against the grain. He said no market crash is coming. Then by late 2023, he sharpens that idea into what he called the reverse market crash, the theory that instead of assets falling, they'd actually be rocketing up in price against a currency that's getting weaker and weaker. And, well, just look at the results of that call. It's pretty stunning. Since December 2023, you've got Bitcoin soaring 186%. Gold is up 95%. Even the NASDAQ has climbed over 50%. I mean, let's be crystal clear here. This is the exact opposite of what you'd see in a 2008-style crash.
So to put a real number on this, imagine you had $100,000. Betting on this reverse crash instead of a normal one would have meant a $76,000 difference in your portfolio. In just 2 years, that is the staggering cost of preparing for the wrong war.
All right, so if the crash isn't where everyone thinks it is, then where is the real bubble hiding? This question, the answer gets to the absolute core of this entire thesis. We're about to pinpoint the true source of instability in the whole system. Every single crash starts with a bubble somewhere. It has to. So if it's not in housing like it was in '08, and it's not just in stocks, what's left? Where is the real epicenter of this financial earthquake we're talking about? The answer, according to this whole thesis, is that it's been hiding in plain sight the entire time. The bubble is in the assets everyone, and I mean everyone, considers the safest on planet Earth: government bonds and the dollar itself. Yeah, the very foundation of the entire financial system, that's where the pressure is building. And this quote here from Air McCam Research just nails it. The current bubble is a currency and treasury bond bubble. Just let that sink in for a second. When the foundation is the bubble, it means that literally everything built on top of it, from the stock market to your 401k, is fundamentally unstable. And that is what makes this scenario so incredibly dangerous. Okay, so what are the symptoms, right? How can we actually see this currency bubble playing out in real time? Well, we're about to look at the evidence, what a flight from cash actually looks like out there in the wild, in the markets. First up, just take a look at the stock market. It's pretty wild. A tiny handful of tech giants, the Mag 7, now make up over a third of the entire S&P 500. But see, this isn't just a tech boom, it's a symptom. You've got all this capital fleeing a weak-looking dollar and just piling into these specific companies. Why? because they're seen as these global fortresses, a better, safer place to store your value than actual cash. And this flight to safety, it isn't just happening in the stock market, not by a long shot. Think about the huge surge we've seen in gold and Bitcoin. Or remember the crazy prices for things like NFTs a little while back? When you look at it through this reverse crash lens, you realize these aren't a bunch of separate, disconnected bubbles. No, they're all symptoms of the same disease. People desperately trying to escape a currency that's losing its value, and they're running to anything they think is scarce. So here's the absolute crucial point. You have to flip the lens you're looking through. Through the old 2008 style lens, all this just looks like wild, crazy speculation. But the moment you realize the currency itself might be the thing that's crumbling, you see this behavior for what it really is: a rational, maybe even desperate, bid for a safe haven. It's not a bubble in assets. It's a collapse in the thing we use to measure those assets: money. And this brings us to what might be the most critical part of this whole thing. Why is a reverse crash so much more dangerous than what we saw in 2008? The answer is simple, and it's terrifying. It's because, unlike last time, there might be no second chances. Yeah, this right here really captures the devastating difference. The 2008 crash, it was a reset button. Assets went on sale, big time. It gave a new generation of buyers a chance to get in the game. But in a reverse crash, there is no reset. Assets don't fall down to meet your cash. They literally run away from it, getting more and more expensive until they're potentially unaffordable forever, all while your savings are just getting eaten alive by inflation. And what this does is it creates this really clear, almost brutal divide. On one side, you have the winners. These are the people holding scarce assets, things that can't just be printed out of thin air, like Bitcoin, gold, or profitable business. And on the other side, you have the losers. And sadly, these are the people who just followed the conventional wisdom. They held cash, they relied on a fixed income, and they stuck to those traditionally safe investments like bonds. And all of that, it leaves us with one final, really critical question that you have to ask yourself. In a world where the very definition of a safe asset is being turned completely upside down, could it be that the money you think is so safe is actually the biggest risk you're taking?